Hi, Luke Stein here. This video is going to introduce a way of thinking about the risk and return trade-off in stock investment when investors are able to diversify components of their portfolio. The key intuition that we're going to reach is that through diversification, some of the risk involved in a component of a portfolio may not actually affect the investor because it is offset by other components of the investor's same portfolio. Because diversification is available, those elements of risk that investors don't care about should not generate higher expected return. There should be no risk and return trade-off for the portion of risk that investors are able to diversify away. We're going to formalize that mathematical intuition using a model called the capital asset pricing model, describing a way of measuring what that systematic or non-diversifiable risk is. We saw earlier that a risk and return trade-off existed for large stock portfolios. For example, a portfolio comprising a large number of companies, of small companies in the United States, had high average annual returns over the last approximately 100 years, and those returns had a very high standard deviation. Some years did much, much better than average. Some years did much, much worse than average. In contrast, an investment in the stock of larger companies like the S&P 500 had lower average returns, but also lower historical realized volatility. We also saw, though, that that trade-off did not exist to the same extent for individual components of a portfolio. Stocks, in fact, tended to have higher volatility. Every stock had higher volatility than the portfolios that they comprised. So why could that be? It's due to diversification. When we think about the volatility of an individual investment, which we might measure perhaps using its standard deviation or variance of total returns, we're saying something about the total risk of an investment in that portfolio. But that total risk, of course, is only showing up for an investor who holds only that investment. And in fact, investors are able to diversify. So what does that mean? It means that the risk in components of their portfolio may offset risks in other components of their portfolio. We can think about the risks that do offset and the risks that don't. We call the former firm-specific risk. This is risk associated with independent shocks that affect one or a small number of firms in an investment portfolio. For example, say you own stock in a pharmaceutical company. If one of their new drugs gets approved, that might represent good news, and we might expect that that investment might increase in value. If there was a fire at a warehouse owned by one of the companies in your investment portfolio, that might be bad news, and the value of that investment might go down. We call these kinds of shocks and the risk that they create diversifiable, idiosyncratic, unsystematic, or independent risks. But the key intuition that we have about these shocks and the risks they create is that it can be eliminated at no cost to the investor through diversification. As long as each individual component represents a small portion of the investor's portfolio and they own lots of other things and small portions of each, the good news in one investment can be offset by bad news in other investments. So diversification can eliminate all of this firm-specific risk. In contrast, systematic risk is associated with shocks that are common to many firms or to the economy as a whole. For example, if the Federal Reserve makes a policy decision that changes interest rates, that could drive the value of many of the components of even a diversified portfolio up or down. If there's a recession, that's likely to be bad news for many companies. If there's a pandemic, similarly, we call these kinds of shocks and the risk that they create non-diversifiable risk. This systematic risk cannot be eliminated through diversification. Good news that affects one element of a well-diversified portfolio, or bad news that affects one element, is likely also to affect other firms in the portfolio and in the same direction. That means that good news will typically reinforce and bad news will typically reinforce. This kind of risk exists even for the diversified investor. And because she can't avoid systematic risk while also being exposed to the market, she should demand compensation in the form of higher expected returns in exchange for holding this kind of risk. So what happens? Portfolio returns turn out to be smoother than the component returns. As long as you're diversified, that idiosyncratic risk gets diversified away. And the time series on the right traces out in lightly shaded lines what the portfolio performance is of individual stock components in a portfolio, and then in the dark line, how the overall portfolio does. And the overall portfolio does well or badly, but less extremely than any of the individual components. So firm-specific risk gets eliminated to the investor through diversification. That means at virtually no cost. Trading is relatively inexpensive. It's no more expensive to hold smaller stakes of 5 companies or 500 companies than it is to take one large position in one firm. And because this risk can be eliminated through diversification, because you can get risk reduction at no cost, we sometimes call this the only free lunch in finance, investors should not expect to be compensated for holding this type of risk. In a sense, it's their own choice and therefore their own fault, and so they can't get compensation in the form of a higher risk premium. So we've said and will continue to say that the required or expected rate of return on any kind of investment is going to equal a risk-free rate plus a risk premium. The risk premium for individual stocks should be driven only by the degree to which they are exposed to systematic risk, not their total risk, because the firm-specific or idiosyncratic risk can be diversified away. So how do we implement that? Well, we need a way of measuring an individual stock's systematic risk or exposure to overall market fluctuations. If we wanted to determine how much of a stock's returns are due to exposure to systematic risk, part of what we need is to understand how much that stock co-moves with the general market, the portfolio that the best diversified investor would be exposed to. So to do so, we're going to need to come up with some kind of proxy that we can use to represent the performance of that general market. And what we'll look for is an aggregate market portfolio that has diversified away all of the idiosyncratic risks. Implementing that leaves us with some choices. Typically, what we'll use is some kind of equity market index that includes small stakes in each of a very large number of companies. So we might use the S&P 500. We might use something like the Russell 3000. There are 2 key things that are going to make a proxy for general market performance a good one. The first is that it should seek to include all investments. We want to make sure that every source of idiosyncratic shock has as many opportunities as possible to be canceled by being offset through a diversifying component of the portfolio. The second thing we want to ensure is that every individual holding in that general market portfolio is really, really small. So even any residual idiosyncratic shock, one that doesn't get offset, shouldn't matter by itself very much because each individual holding only represents a small fraction of this diversified portfolio's aggregate market portfolio. So what do we do with that? Well, we compare the performance of the market portfolio to the performance of an individual stock that we're interested in analyzing. So what I'm showing on this slide are 3 different time series where the red line on each one is the same. So we're tracing out through time the performance in the red line of the overall market portfolio. Obviously, this is a stylized view and things don't look quite as symmetrical up and down or quite as smooth, certainly not as predictable as this implies. But we can see in the time series that we're showing periods where the market does well and periods where the market does badly, periods where the market does well and periods where the market does badly. So we're tracing out on each of these graphs the magnitude of market fluctuations. And then we ask, what happens to an individual stock? So each of the green lines are designed to show on the same time series and on the same scale the performance of some individual stock. In the left-hand graph, we can see a stock that moves more than the market. So when the market goes up, it tends to do really well. When the market does badly, it tends to do really badly. So the stock on the left-hand side tends to move, as I said, in the same direction as the market, but even more than the market does. In the graph in the middle, we're plotting in green a stock which moves with the market. So good news for the market tends to be good news, bad news tends to be bad, but moves less than the market. So this is a stock whose systematic risk is positive. It has some exposure. When the market does well, it does well, but it moves less than the market does. And in the third graph I've plotted, although it's actually fairly hard to find these things in the real world, I've plotted what it would look like to have a stock that moves in the opposite direction of the market. So when the market goes up, this green stock goes down. When the market goes down, this green stock goes up. So on average, this third stock tends to move opposite the market. Now, of course, real data doesn't look as clean or as clear as this does. So typically what we'll do is rather than try to trace out time series graphs, and when I say real data, you'll note that, for example, the real time series that we showed for a diversified portfolio a few slides ago is very, very messy and hard to actually kind of analyze with your eye the way it would be here. What we'll typically do instead is we'll actually draw scatter plots or analyze scatter plots using the underlying data. So if you imagine dividing the time series in this graph up into different periods, say different weeks or different months, you can identify a period of time where the market has gone up and the stock has gone up even more, where the market and the stock have both done nothing, where the market has gone down and the stock has gone down even more. And so if we then take these time series slices, we could imagine plotting them on a scatter plot. And that's typically what we'll do. So each of the dots on each of these 4 graphs are designed to represent what we would see in a given period of time. So for example, this dot right here represents a month where the market has done well. It's to the right on the horizontal or market return axis. So the market has done well, and the individual stock in question has done well. Investment return is positive. So this is a good month for the market, and it's a good month for our investment. In contrast, this is a good month for the market, but this was a month where this stock in question actually moved opposite the market. It went down a little bit when the market was up. But if you sort of look at the scatter plot, you can see these dots represent a pattern of data about which we might say, this stock tends to move in the same direction as the market. When the market's up, this stock tends to do well. When the market's down, this stock tends to go down. And if we were to analyze this using linear regression, we might expect to see some kind of positive slope like that. Now, of course, the regression line does not exactly predict the investment's performance. So sometimes the stock does better than expected by the regression line, and sometimes the stock does worse than predicted by the regression line. So what are these deviations that we're observing in the vertical dimension above and below the regression line? Well, that's idiosyncratic risk. So what I just drew was a positive idiosyncratic shock. The firm got some kind of good news. Maybe their drug got approved. Maybe they had some other kind of input cost went down, but that's a positive idiosyncratic shock. The firm did better than expected given market performance, and that would be an example of a negative idiosyncratic shock. The firm did worse than would be expected by market performance. But generally, this regression line suggests, hey, this is a firm which tends to do well when the market does well. And if we imagine, for example, this graph here shows a different firm. The market still goes up and down, so the horizontal axis is the same, but the vertical spread of each dot looks a little bit different. And it turns out that this data is actually consistent with a similarly sloped regression line. It's just that this is a firm which tends to have more large-scale idiosyncratic shocks. So the firm on the top and the firm on the bottom have the same level of systematic risk. When the market goes up, they on average go up by the same amount, but the firm in the top panel has lower levels of idiosyncratic risk than the firm in the bottom. And if we move to the second set of graphs on the right-hand side, you can see the regression lines here look quite a bit steeper. So these are firms that tend to move more than the firms on the left-hand side. When the market goes up, they tend to do really well. When the market goes down, they tend to do really poorly. So we're going to actually run these regressions, but the graph is designed to illustrate the difference between firms that have low versus high systematic risk on the left and the right-hand side, and low versus high idiosyncratic risk, comparing the top versus the bottom. And because of those idiosyncratic shocks, the degree to which the dots lie above or below each of the regression lines can be diversified away just by holding more than one company in your portfolio. Investors should not expect an additional risk premium for moving from low to high idiosyncratic risk shocks. All of the risk premium that they should expect to earn is going to be associated with a move from low to, high idiosyncratic risk on the left-hand, from the left-hand side to the right-hand side. That higher systematic risk means they're going to see more movement with market fluctuations, and because they don't like that movement, they should expect to earn higher returns as compensation. So only systematic risk is going to wind up mattering in a diversified portfolio, and we're going to estimate exposure to systematic risk using the slope of the regression line that I just showed you on the previous slides. We're going to call the slope of that regression line a stock's beta, or CapM beta, where CapM is the capital asset pricing model that we're implementing here. So beta is going to be the slope of a linear regression line between a stock's return, that's going to be the dependent or Y variable, and the market return, which is going to serve as the independent or X variable. And it's going to measure the magnitude of the co-movement between the asset in question and the market aggregate as a whole. So if the market moves in the same direction as the stock, or rather if the market and the stock move in the same direction, but the stock moves more than the market does, we're going to wind up estimating a beta which is greater than 1, and we call that a high beta stock. If the stock in question moves with the market, but on average with the same magnitude, we're going to, that's a beta equals 1 stock. That stock has as much systematic risk as the market. A stock which moves with the market, but has smaller amplitudes, we call a low beta stock. And it's going to have a beta which is less than 1 because it moves less than the market does, but greater than 0 because it moves in the same direction. An asset which is totally uncorrelated with the market, for which the regression line is horizontal, which moves in no systematic pattern relative to overall market movements, is going to have a beta of 0. And then finally, a stock which moves in the opposite direction of the market movements that the market moves is going to be one that has a beta that's negative. And you can think a little bit about what kind of stock or what kind of industry you might imagine does well when the market is going down, does badly on average when the market is going up. So we can estimate betas for individual stocks. We can also estimate betas on average for an industry. And this slide just shows a list of 49 aggregated industries and then estimated beta or regression coefficients for companies, public companies in the US in each of those industries. I'm not going to talk too much about this, but if you sort of start to look and think about it, you'll notice some patterns that are consistent with your intuition about what might drive exposure to higher versus lower levels of systematic risk. And again, remember that exposure is telling you something about whether this industry tends to move as much or more than the market as a whole. So for example, in the upper left-hand corner, we see some examples of really low beta industries like the utility industry, the food and beverage industry, and smoking, the production of tobacco and smoking products. So beta's positive, but much less than 1. It turns out that even when the market is going up, or let's say the economy is doing well, people still have to heat their house. They still have to cool their house. They still have to turn their lights on. They still buy food. They still buy cigarettes. Now, those betas are positive, consistent with the idea that, maybe people crank the winter heat a little bit more, crank the summer AC a little bit more, leave their lights on even if they leave the house and feel more comfortable doing that when the economy is booming or when the market is going up. But you gotta use your utilities. This is an essential good. The same is true with food. Maybe people upgrade their purchases a little bit, but the food industry is going to sell whether the economy is doing well or poorly. People smoke cigarettes whether times are good or bad. They maybe do more when times are good than when they're bad, but they're going to do it either way. And that's consistent with low, although of course positive betas. In contrast, on the right-hand side, you can see high beta industries, so industries that have beta significantly in excess of 1. And so think, for example, down here we've got chips and semiconductors, and then we've got software production. So what's going to drive profitability and therefore presumably stock price increases for companies in these industries? Well, it's going to be things like people upgrading electronic devices, individuals and companies, or buying new software. Well, you've got your iPhone 10, it's getting to be a couple years old. You're trying to decide whether to replace it. You're much more likely to do that if the economy is doing well, if your stock portfolio is up, if the market is performing well. So good news is really good news for companies that make more luxurious goods, goods where the purchase are subject to discretion, and it could be accelerated during good times and delayed versus bad, or where they maybe have the ability to capture premium pricing. So we see like hardware, for example, during good times. So this is what betas look like for different industries. And the CapM is going to tell us that generally speaking, these high beta industries should deliver higher average returns to investors than these low beta industries, because the low beta industries represent relatively safe investments. They may not go up as much as the market, but they tend to deliver positive returns when the market's going up. So what exactly does CapM say? So we know that the expected return on any asset is the risk-free rate plus some kind of risk premium. And CapM tells us how we can quantify that risk premium. So we've got a risk-free rate, and what are we going to add? We're going to add a risk premium, and the CapM implied risk premium is going to be the product of CapM beta and what's called the market risk premium. And that market risk premium is the difference between investors' expected return on the market and the risk-free rate. So the market risk premium tells us how much higher expected returns do investors demand or require to hold one beta unit's worth of risk. And anything which has a high beta is going to generate a higher risk premium. Anything which has a low but positive beta is going to generate a low risk premium. Anything which has a zero beta is going to generate no risk premium because those assets are risk-free or at least systematic risk-free. And if you think about the extreme asset that has a negative beta, it's actually going to generate a negative risk premium. Well, what does that mean? How could an asset generate a negative risk premium? Well, a negative beta asset is one that on average moves in the opposite direction of the market. So when the portfolio is doing badly, this asset is going to do well. Assets that have a negative beta serve as insurance on the rest of your portfolio. They move in the opposite direction, and so when your portfolio goes down, this negative beta asset is going to help bring your returns back up towards zero or perhaps even positive. And like any insurance policy, you should, generally speaking, expect to lose money. I don't buy auto insurance because I think I'm going to earn a profit on my auto insurance policy. I know I'm probably going to lose, but I'm willing to pay those negative expected returns in anticipation that it will pay out exactly when I need a payout. And that's what negative beta assets do. So if we plug different values of beta into the CapM, what we get is that if beta is greater than 1, that means if we have an asset which moves with larger amplitude than the market, but with the market, that beta greater than 1 is going to give us a market risk risk premium, which is greater than the market risk premium, because we multiply the market risk premium by something greater than 1. And if you do a little bit of the algebra, you'll note that for a beta greater than 1, this market risk premium, which subtracts off the risk-free rate before we add the risk-free rate, is going to wind up generating a positive risk premium in excess of the market risk premium. And that means that the expected return on an asset with beta greater than 1 should be higher than the expected return on the market. Now that may have sounded a little bit confusing, but the intuition is actually very straightforward. The market as a whole has a beta of 1. Okay, beta told us about the regression coefficient on or the slope of the relationship between market returns and stock returns. So a beta of 1 is an exactly 45-degree line. Beta of 1 corresponds to risk or systematic risk as high as the market's level of risk. An asset which has beta greater than 1 is riskier than the market, and therefore investors demand and can expect to earn rates of return higher than the market's rate of return. In contrast, an asset with a beta of 1 has expected returns, has risk equal to the market's risk. It moves with the same amplitude as the market. And when we plug in a beta of 1 to the CapM formula, you'll see that what we get is when we multiply a beta of 1, we get the risk-free rate plus the expected return on the market minus the risk-free rate. And so that risk-free rate plus and that risk-free rate minus are going to cancel, and an asset with a beta of 1 is going to generate an expected return exactly equal to the market's expected return. If you invest as risky as the market, you should expect to get a return as high as the market's going to deliver. Similarly, if beta is less than 1 but positive, you should expect to earn some positive risk premium. Okay, so an investor who invests in positive beta less than 1 assets should expect to earn a rate of return which is in between the risk-free rate and the market's expected rate of return. A beta of 0 asset should generate a risk-free return in expectation, and those insurance-style assets that have negative beta should generate a negative risk premium and therefore a rate of return lower than the risk-free rate. And investors should not necessarily expect to lose dollars, but to do worse than they could just by putting their money in something risk-free. So in the same way that we estimated betas for at the industry level, we can estimate betas for individual stocks. And this turns out to be the typical thing that we will do in order to try to figure out what rate of return investors should and perhaps do expect to return when they expect to earn when they invest in an individual company stock. So if we think, for example, about P&G, the large consumer goods conglomerate, we could estimate for them using stock price data a beta of 0.5. That 0.5 tells you that P&G tends to move less than the market does, although in the same direction. And because it's safer than the market, investors should expect to earn a rate of return which is lower than they would earn on an overall market portfolio. And if we were to plot what this CapM formula, which I've just reprised here on the slide, so this is the same thing we saw before. It says the risk-free rate plus beta times the market risk premium. That's a linear formula, and it's a linear formula in beta. So we've got the risk-free rate plus beta times the market risk premium. If we plot that thing on the lower graph, we do that, you can see what it implies. So on the horizontal axis, we've got beta. Okay, so Ford is a high beta stock. People tend to buy more and fancier cars when the economy is doing well. Apple is a high beta stock with a beta in excess of 1. They might upgrade their computers or their phones or buy Macs instead of cheaper PCs when the market is doing well. In contrast, Coca-Cola, etc., are over on the left-hand side. So towards the right, we've got high beta or high systematic risk. Towards the left, we've got low beta or low systematic risk. And then on the vertical axis, we're plotting expected returns. So this is the outcome of the CapM formula. It's the risk-free rate plus beta times that market risk premium. And the key points that we can observe on this graph correspond exactly to key portfolios we might have in mind. So a beta of 1 means an investment that's as risky as the market. And if we trace that out, we see that it should deliver an expected return exactly equal to whatever we think the expected return on the market is. In this case, it looks like about 9% is what we're plotting there. In contrast, a beta of 0 corresponds to a risk-free asset, and the data on this graph is consistent with having about a 3% risk-free rate. So the upward sloping line that we see that runs through those 2 points shows us how different companies' stocks where we've estimated betas line up. And the higher beta stocks generate higher expected returns. The lower beta stocks generate lower expected returns. And that's going to be our key risk and return trade-off when it comes to individual stocks. As long as we measure risk using this beta measure, we should be able to trace out a risk and return trade-off in expected returns and beta space. So let me show you how we'd estimate one of these betas. Come back and I'll give you 2 quick caveats about the estimation procedure. So here what we've got is data on the Russell 3000, which is going to serve as our market aggregate index. So this is weekly data on the performance of 3,000 US stocks in aggregate. And then we've got a price for 2 other stocks. In column C, we've got McDonald's, MCD. And in column D, we've got Southwest Airlines, whose ticker is LUV. They land and take off out of Love Field. Or did originally. That was where they started. So this is weekly data on prices, and we can use that price data to generate returns. So what did the Russell 3000 do in the week ending April 8th, 2014? Well, it ended at $1,087.13. What rate of return did it earn? I have no idea because I don't know what it started the week at. So I'm not going to be able to say anything about that week, but if I move down to the week ending April 14th, I can calculate the return using the ending price of 1116.06 minus the beginning price of 1087.13. So an investor in the Russell 3000 that week, saw that price go up by $28.93 or points, as the case may be. But what we want is a rate of return. So let's divide that by what the beginning investment amount had been of 1087 and show that again as a percentage. And so over that week, the Russell 3000 returned about 2.7%. And if we wrote that formula correctly, we should be able to paste it into other cells. So in the following week, when the Russell 3000 went down from 1116.06 to 1113.75, that means that it lost 0.2%. We can do the same thing. And again, if we wrote the formula correctly, we should just be able to copy the formula over. So McDonald's went from 95.96 that week to 96.89, which means it went up about 1%. And what did Southwest Airlines do? It went up 3.3% in the same week. So just using the first 3 weeks of data to say something about what the first 2 weeks of returns might have looked like, we can start to see that we have a week where the market went up and McDonald's went up, but less than the market did. Southwest Airlines went up, but more than the market did. And then in the second week, the market went down, but McDonald's went up and Southwest went up a lot. So, of course, things don't move perfectly in the same direction or opposite direction as the market. The patterns are sort of inconsistent. And the reason they're inconsistent is because these companies are also being hit by idiosyncratic shocks along the way. So let's copy these formulas all the way down in the Excel spreadsheet. And what that gives us, if we select all, what that gives us is, if we look at the countdown here, 52 weeks worth of returns data for each asset. So for each one, we could calculate the average rate of return. So over those 52 weeks, the Russell 3000 averaged a return of 0.3% per week. McDonald's averaged a return of 0.02% per week. Southwest Airlines averaged a return of 1.26% per week. And just based on those average returns, you might start to conclude it seems likely that Southwest moves more than the market and McDonald's moves less than the market. But of course, it could also just be that Southwest Airlines had a really good year and McDonald's had a really good year. Let's see about risk. So let's calculate the total risk or standard deviation of returns on the Russell 3000. And the weekly standard deviation of returns there was 1.66%. For McDonald's, it was 1.79%. And for Southwest Airlines, it was 4.38%. So you can see that as expected, the market portfolio looks less risky than either of the components of the market portfolio, despite the fact that it turns out to have performed better than McDonald's. That, of course, could just be good luck. Well, what about beta? Beta is going to be the slope of the regression or the regression coefficient, where we have McDonald's performance or returns, not prices, but returns on the Y or dependent axis, and we've got market returns on the X or independent or horizontal axis. The easiest way for me to calculate those in Excel is to use a function called slope. And slope, it then tells me, although I realize it's fairly small in the Excel, in the recording, that first it wants the Y's. It says known Y's. That's going to be the dependent variable, which will be all of my McDonald's returns weekly. And then it wants the known X's, which are going to be my Russell 3000 returns. And if I ask Excel to run that regression coefficient for me, it's going to estimate that McDonald's tends to co-move 48% or 0.48 as much as the market does in the same direction. And if in Excel I lock in that column H, because I always want to be using the market returns, so if I put dollar signs in front of those H's in the formula, then when I copy and paste that formula over for Southwest, it should still be referencing the market as intended, but have now the LOVE returns or the Southwest Airlines returns as the dependent variable. And we learn that we have estimated using this weekly data a beta coefficient of 1.11 for Southwest Airlines. On average during that year, Southwest Airlines indeed moved more than the market, 11% more than the market and in the same direction. And one thing that's always worth doing when you run these formulas, just to check that you've entered them correctly, but also should deliver a result in accordance with intuition, is you can just check what's the beta of the market with itself. What do we get if we run a regression of market performance on market performance? And of course, the slope there we should expect to be 1. The market moves as much as the market does, and the market moves in the same direction as the market. So this is how those regressions wind up looking. We've estimated a 0.48 beta for McDonald's and a 1.11 beta for Love. If you want, we can select the data. Let's just do McDonald's, and we can insert a graph. And so if I do insert, I'm sorry that it's off the recording, but if I go to the menu and I choose insert chart, and then the chart I'm going to choose is an XY scatter plot, Excel will just insert a somewhat ugly and default formatted graph, but one that we could update to look the way we want it to, which shows us on the horizontal axis market returns or Russell 3000 returns, on the vertical axis McDonald's returns. Each dot is one of the weeks of data, and you can see that the slope of this regression line looks to be less than 1. This thing is flatter than the 45-degree line, consistent with McDonald's having had a beta which was less than 1. So what's that going to mean for CapM? Well, because McDonald's has a beta which is less than 1, it means that investors should expect on average that McDonald's would deliver a lower return than the market does. And that turns out, in fact, over the course of this year to have been the case, although it didn't have to be, given idiosyncratic risk. Given that Southwest Airlines has a beta greater than 1, that means that an investment in Southwest Airlines has more systematic risk than an investment in the market. Investors should expect, according to CapM, to receive higher expected returns in Southwest Airlines than in the market. And it turns out ex post that indeed they did over the course of this year. When the market went up 0.3% per week on average, their Southwest investment went up 1.26% per week on average. So 2 quick caveats, which I would just consider kind of bonus content on estimating these betas using this kind of regressions. The first is that the returns that we should be using to estimate these regressions should in fact not just be price changes, as we just did in Excel. It should also include dividends. So we really should be being careful about any weeks during that year in which McDonald's or Southwest wound up paying a dividend. In practice, people unfortunately often don't do this. It's very typical to do what I just did in Excel and just use the capital gain yield, that is to say the change in prices, rather than the total return. Now, if you imagine that McDonald's paid, let's say, an annual dividend during the year in question, that means that there's going to be 1 out of our 52 data points that was mismeasured. If they had a quarterly dividend, 4 of the weeks will have been mismeasured. And in practice, people often just ignore that because dividend payouts are relatively rare. But to do this right, you really should be looking at the total return, although that would require you to get dividend data, and often people are lazy and just don't. The second thing that I would just note as kind of a bonus caveat is if you look at what the CapM formula actually says, okay, so here's the CapM formula. It says that the expected return on an equity investment is the risk-free rate plus beta times the market risk premium. You'll note that on the left-hand side, we've got the return on the equity in question. So the Y variable in our regression might be McDonald's returns or Southwest returns. But on the right-hand side, what we've got multiplying the beta is not the market return, but the market's risk premium. So the market return in excess of the risk-free rate. And in addition, on the right-hand side of the regression, we also have this risk-free rate. So the sort of problem, if you're statistically inclined, that you may notice is that the risk-free rate can change over time. And so we sort of should be including it in our regression in some way. And the typical way that we would do that if we want to do it correctly, although we often don't, and we're a little bit unfortunately lazy, is instead of doing the regression that I just showed you in Excel, where we regress stock return on market return, we should instead be regressing the stock's excess return. So subtract off the risk-free rate, and do RE minus RF on the left-hand side of the regression, and then on the right-hand side of the regression, do the market's excess return, the return on the market minus the risk-free rate. In practice, we often don't do this, in part because the risk-free rate doesn't tend to change that quickly, and also at a daily or weekly or even monthly frequency, which is how we would usually estimate CapM betas, the risk-free rate tends to be very, very low. You don't earn a high rate of return having your money in the bank or in treasury bills for a day or a week or even a month. And so this is another thing that unfortunately we often just ignore rather than bothering getting the data. But if you really want to do this right, you should also be getting dividend data and getting risk-free rate data and running a regression of total returns or total excess returns on individual stocks on the total excess return on the market.